Carl has a question about thinking into the future. And so he asks, what advice would you give concerning how to best navigate recessions? And given recessions are a cyclical part of the economy, and this is something most of us will face multiple times in our life. And I think just generally, like during recessions, people just get really afraid and want to change their financial strategy. Like, what's your advice on that?
So two things. So one is you maintain your strategic reserve. I'm not sure how much was cut off when our connection was lost, but when you have that 3 months strategic reserve, you have the peace of mind that you can weather a storm more easily, and you can actually budget and plan. Without that strategic reserve, you're just jumping around from trying to go from paycheck to paycheck, and that was my life until I was about 40, just worrying, am I going to bounce a check, or how close am I to the end of the month? Now, on the recession issue, first of all, don't try to time any of your investments to try to predict whether we're entering an investment or now, because we are in a recession. It's a good time to do one investment rather than another. You basically you want to be constant and keep a reasonable amount of your investment portfolio in stocks. And if the stock market plummets, that's actually a good time to buy more stock. Not because because I can predict where the stock market is going, but just because you probably, as a proportion of your wealth, you're sort of below where you want to be if the stock market has just plummeted. So I like once a year I kind of rebalance my investments, and during a recession that tends to mean I put a little bit more into stocks. But the main thing I do is I save my money. I try to save 20% of my money so that I can weather a recession in terms of my personal life, and then I kind of don't worry about it in terms of my day-to-day investment decisions. And that's probably the best advice I can give about recessions.
You touch a little bit on this in your book, but as far as like a percentage in equities versus bonds, and there's generally a formula you talk about, and I guess generally when you're younger you want to have your more of your money in equities and less in bonds, and then as you get older, can you just sort of talk about that and the logic behind that?
Yeah, so when you're young, if the stock market drops 30%, you don't have any reason to care about that. You just keep buying stock and you just kind of keep going, because you've got years and years and years before you really have to worry about it. So when you're just starting out, you want to have almost all your money in U.S. and world stocks, and you want to have something that gets past the sort of S&P 500 into the entire stock market, including small companies. So a sort of total stock market index type fund is a good choice. As you get older, you want to take a little bit less risk. And so what one rule of thumb that we talk about in the book a little bit is that if you take 110 and you subtract your age, that's roughly the amount in your portfolio that you want to have in stocks. And so as you get older, you become a little bit more conservative and have more of that money in safe securities. One way you can manage that, if you don't want to worry about some of these issues, you can get a target date fund where you say, I'm going to retire. Let's say I'm going to retire on January 1, 2040, and so I can get a target date 2040 fund, and that's what they'll basically do. Is they'll sort of start out right now. It'll be very weighted towards stocks. As it gets near your retirement, it starts to be a little bit more conservative. I think the Freakonomics audience is a pretty young audience. You want to have most of your investments in stocks. So, and over the long run, you sort of need that growth. Ironically, being too safe over your entire life is very risky, because it increases the risk that your money won't grow, and therefore that you'll outlive your savings if you live, if you live to be 95. So you want to, when you're young, you want to take advantage of that compounding to really load up on stocks and then gradually pare it back.